Oh,
Yeah, so it was,
it's right on the other side by the window.
Yeah, so I,
but good to see you, I'm so happy you're here.
I know we're able to.
I think you're gonna like it. And then,
I just figured Christy was tired and I already know that
oh
you're
yeah,
tired.
I just, yeah, I thought there
Okay.
was no.
Well,
I'll see.
Anybody know how to whistle?
I'm good at that.
Yeah, she is, yeah.
I invite you to
Do this. Like, you don't know
It was like, we don't really know what we're doing.
I know, yeah.
You never know what
It was like,
I was just talking with Tracy about it. Once you see how it goes, you're gonna
It's
realize.
now it's like just
yeah,
dipping
so.
our little toe in it. Like
Good to see you.
Don't you know how to whistle?
coming down here, I had the car in autopilot and I was talking to AI Grok.
Okay, we are wanting to start, if everybody could find a seat.
Yeah.
I gotta get the cane from my boss.
Yes. Sure, I've got your piece.
It's great you can all join us this morning. Borrowing money from a bank is nearly impossible. That's what I could have said a couple of times in my career. That's not true today. Today, it's very possible. I will say the caveat is, you have to do a little bit of homework. You have to get ready, get prepared. And that's what we're gonna talk about today. So, thank you for coming. You online, thank you for joining us. We're gonna obviously leave some time at the end for questions, but if there's prudent questions that come up throughout, please raise your hand and let's ask those questions. And folks online, if you have questions, please put it in the chat and we'll get to those questions as well. My goal for you today is that you'll walk away with some nuggets, some pearls of wisdom, a few things that you can take home today and start putting into practice to help prepare you and your business to get ready to get funding. Because today, bankers want to lend you money. Bankers also want to get paid back. So, that being the case, is why we're gonna have this discussion today. So, I am Brian Kaiser. I am here with Anthem Strategists. I am a fractional CFO. Yes, many of you know what that means, many of you don't. I'm a chief financial officer, working with many small businesses, so I'm fractional. So no one company pays my full salary, they just pay a piece of it. And just like an attorney will have multiple files on their desk, I will have multiple client files on my desk also. And so work with a lot of small businesses. I say small, meaning small in dollar size, under 50 million, but not irrelevant. Because every business I work with is relevant to the owner. It's incredibly relevant and important to them. And so when I say small business, I don't mean it disparagingly. It's very critical to our economy and to Main Street USA. And so the great thing about being a fractional CFO, I get to help customers get visibility into their cash flow, help with cash flow profitability, forecasting, planning, lender readiness, which we're going to talk about today. The great thing though that we have today also is great banking partners, like the folks here at People's Bank. Like I said, banks want to lend you money. They're also great strategic partnerships to have. They will give you insight and advice into your business that comes free. And so utilize them. And partnering with us today is going to be People's Bank, like I said. I'd like to introduce you to Mark Rodewald, the market president for People's Bank.
Thank you, Brian. Thank you for coming. You can't beat Chick-fil-A in bank financing, right, or financial statements. So thank you for coming. And again, my name's Mark Rodewald, market president for People's Bank. The team you have here with me is Victoria Shinn
Good morning.
and Drew Chapman
Good morning.
and Melissa Maurer. So we're happy to be here. We hope you get some nuggets of wisdom here, and we generally never get an opportunity to prep businesses before they come in and ask for credit. So this is a great opportunity to really do some baseline work and be prepared. Trust me, this will make your life a lot easier as you look for credit for your financing needs. So thank you again for coming. Thank you, Brian.
And piggyback on that, a lot of times when I walk in with a new client, one of the first things they say is, we need to borrow money. And said, well, what have you done? And they have a lot of homework to do. And so that's one of the places we start, is right there, right off the bat, with helping them prepare to borrow. So what we're gonna do is we're gonna reframe the conversation today. It's important that we look at it this way. Borrowing or getting ready to borrow money is not always about revenue. Revenue is great. Growth is great. It's fantastic. We want that. It drives the economy. A lot of great benefits. However, revenue won't get you approved. Second line, we'll talk about what actually gets you funded and what actually works. That's where we're at today. Let me start you off with a story. I like stories because I have dozens of them. And I'm working with a contractor recently, about 12 million. I walked in there, and of course, like I said, the first thing they want to do is say, we need to get about a $500,000 line of credit for working capital. I said, okay, so let's see your financials. I said, okay, you got some work to do. First thing, when I talk with a client, I always go to their bank first. I don't start recommending all these different banks. Let's talk to your banker, because you have a relationship. Let's see what they have to say. Bless this banker's heart. I love them because they did not hold back. They looked at the financials and said, I like your revenues growing. That's wonderful. However, your profitability isn't where we want to see it yet. Your balance sheet stinks. You're too over leveraged. You have negative equity, and all of a sudden, the owner's eyes start rolling back in their head, and they were depressed for 3 days. They wanted to borrow money. Said, don't worry, it's not the end of the world. It's just going to take us some work. So we started going to work, and it took us a few months, took us 6 months about roughly, and we had their balance sheet cleaned up a little bit. The banker will actually talk to us now. And so I say that because bankers, they'll be honest. They'll be friendly, they'll be wonderful, but good bankers, if you have a good banker you're working with and they'll be honest with you on the financial health of your business, they're worth their weight in gold. And so utilize them and trust them on that. What gets you approved is gonna be cash flow, reliable cash flow. And I'll say this again and again and again. Bankers like predictability. They like to know that what you say your cash flow is today, and it's gonna be tomorrow, and it will be the month after that, is what truly happens. Because as the bankers will talk here in a minute, if they know that that they can trust getting their money back, they're gonna be very willing to get you some money. I mentioned this story that leverage is a big piece. A lot of times people need to borrow money, but they already have borrowed probably more than they should have. And these are serious conversations that you need to have with your banker and your CFO. And so these are the important topics that we're going to touch on today. Now, what will banks actually look at? So Drew, I'll let you step in on the first couple here.
Good morning, folks. Thanks for joining us so early today. Brian has obviously mentioned a lot about what we're gonna talk about and what we're actually looking for. So we can start with cash flow versus revenue and why what the difference is and why it matters. So cash flow is the real money in and out of your business, right? Well, revenue is the total amount that you've earned. So it's helpful to understand the difference because revenue can look impressive even when cash is dangerously low. Cash flow versus revenue. Revenue shows performance, cash flow shows survival. And what we mean by that is revenue is the total income your business earns from selling products or services. It reflects demand, growth, and sales performance. Cash flow, however, measures the actual dollars entering and leaving your bank account. The money you can use today to pay your employees, your suppliers, and your rent and your taxes. Revenue can be misleading. Revenue is recorded when it's earned, not necessarily when cash is collected. A startup may book 500,000 in annual contracts, but if customers pay at the 30, the 60, the 90-day terms, the business still struggles to cover payroll in the month. This is why business owners who rely on revenue numbers often overestimate their financial health. Cash flow reflects liquidity, your ability to operate. Cash flow shows whether you can meet short-term obligations. Positive cash flow means you have enough money to run the business. Negative cash flow means you're spending more than you're receiving. And so why does this matter? Revenue is vanity, cash is reality. A business can grow revenue while still running out of money. Cash flow determines whether you can pay your bills, hire staff, invest in growth. Investors and lenders care more about cash flow than revenue because it reflects real financial health. Misunderstanding the difference leads to overborrowing, missed payroll, and failed growth opportunities. Then we kind of get into the debt service coverage. And here, we'll get into this a little deeper in the next slide. So let me just provide what it means and why it matters. The debt service coverage ratio tells you one simple thing. Do you generate enough operating income to pay your debt obligations? A DSCR of 1 to 1 means you can cover your debt. Below 1 to 1 means you can't. It's a financial metric that compares your net operating income to your total debt payments. It answers the question, can my business comfortably pay its loans? Why does this matter? Well, obviously, you don't want your loans to go bad. You don't want your business to fail. But it determines your ability to borrow as well. Banks and investors use DSCR as a primary indicator of whether your business can handle more debt. A strong DSCR increases your chances for loan approval. It protects you from over-leveraging, as Brian had mentioned earlier. A low DSCR signals that taking on more debt could strain your cash flow and put your business at risk. It reveals operational health because DSCR is based on operating income. Again, talking about that cash flow versus revenue. It forces you to look at how efficiently your business runs, not just how much revenue you bring in. Talk about some clean, consistent financials.
I'll jump into that piece, yeah. Yeah, clean, consistent financials, this is a big piece. And I'm gonna introduce something that hopefully is not insulting, but I will say that banks often are evaluating the management team and the owners as much as they are evaluating the finances. And so the term that I like to use is management competency. Don't take that in a bad way, but the bank is gonna look at the management team and the owner. Are they gonna be able to do what they say they can do? Does this team, does this owner, do they know their numbers? Do they know their business? Do they know what their business is gonna do in the next 5 months, 6 months, 12 months? Do they have any plans in place, and how are they doing at following their plans? These are the soft skills that the bankers are looking at for the owner and the management team. Because if the money's there, great, but if the owner or the team running the business is not capable of achieving what the plan says, the bank's gonna have second thoughts about doing that. Yes, Kelsey?
As you were saying that, I was thinking, do I need to have my Shark Tank pitch ready for the bank? You know, they're always like, know your numbers, know this, you need to know that. Like, is that really where you need to be?
I'm gonna use that next
Okay,
time. Yes,
alright.
Shark Tank, because it's exactly it.
Yeah.
You need to know your numbers. And I would say, this is where your CFO comes in. Your CFO, if you don't know your numbers well, your CFO does. They know what's going on in your business. They know what it looks like you're gonna be doing. Your CFO is going to be the one that is looking at your numbers, advising you on your numbers, helping you interpret those numbers and evaluate those and make decisions based upon that. And they'll be educating you so you understand what those numbers mean. That is an important piece. You need to know what the numbers are in your own business. And if the banks know that you understand your numbers, the trust level goes up. If they start asking you questions and you get that deer in the headlight look, the trust level starts to go down. If they start asking you numbers about your financials and you start hemming and hawing, they're gonna start questioning whether or not they can trust the numbers. So I will share that with you, but yes, the Shark Tank pitch is exactly it. You need to know your numbers, know your business, know what they all mean. And then the bankers will love to hear and talk to you. Let me share one more story. I was working with a client. I started working with them. They had shared some forecasts with their bank a few months before, and like 6 months before, and we went in to meet with their bank, and the banker said, "Here's the forecast you gave me 6 months ago. How have you done?" And they said, "Well, here's what we've done." They didn't equate. Like, you said you were gonna do this, you didn't meet those numbers. So with the client, we had new 6-month forecast. Do you think the bank is gonna put much credence in those numbers? No, their trust level was way low. So we had a lot of homework to do to start building up that relationship with the bank, building up our credibility, and solidifying our numbers. Not only our income statement and our cash flow, but our whole balance sheet. We had a lot of work to do on our balance sheet. So we talked about clean, consistent financials. Your books historically have to be clean. We have to button those up, make sure they're good and clean and accurate. Make sure your books are closed in a timely basis. If we're in April and you haven't closed 25, that is a problem. Bankers don't like to see that. I hate to make them sound bad, but I'm just saying, it's like, if your best friend came up to you and said, "Will you loan me $50,000? And what for?" "For my business." "Well, what are you doing?" "Oh, I'm gonna start a business." I mean, even your best friend, you're gonna ask a lot more questions. You're gonna want a little bit more confidence than just because we've been friends for 20 years. That's not gonna cut it with a best friend, not gonna cut it with a banker. They need more than that. They need solid numbers that they can build confidence in and trust and depend upon. The last thing is visibility. And I say that in the operations. The bank, a good banker they're going to get to know you, they're going to get to know your business. They want visibility into you and to your company. And the better they know your business, the better they're going to be able to help you and to loan you money. And so the better that you are at giving them visibility, the better off you're going to be. And so that's going to be key, is making sure that you have good visibility yourself into the business, but sharing that with your banker is going to be key. Now, Drew talked about debt service coverage ratio. She can go a little bit deeper into that right now.
So when we talk about the debt service coverage ratio, we're talking about how your business can repay its debt, right? So as we discussed in the last slide, the DSCR really means how we're gonna discuss a little bit more about DSCR, what it means and why it matters. So to expand on that, as I mentioned, the DSCR is a financial metric that compares your net operating income to your total debt payments. Are you all aware of maybe what your net operating income is and how you get there? You're gonna take your revenues, right? And you're gonna reduce your expenses to kind of come up with that. So your revenue minus your operating expenses, excluding interest, taxes, depreciation, and amortization. Total debt service equals all required debt payments, principal, interest, and leases. So the formula is simple. To get to the DSCR, we're gonna take the net operating income and divide it by that total debt service. So what we're looking at is a ratio that's greater than one, right? Because we've already determined that if your ratio is greater than one, you have working capital, which we will get into a little bit more in a little bit, but you earn more. So with a DSCR greater than 1-to-1, you're earning more than enough to cover that debt. And lenders see you as a safer bet, right? Because we're really here, we're also minimizing risk for our institution as well. The debt service coverage ratio on a 1-to-1 is exactly what it sounds like. You're breaking even. You're getting your debts paid, but you're not having anything left over to make any additional purchases or expand on your inventory. The debt service, if it's less than 1-to-1, then you're not generating enough income to even meet the obligations that you've signed up for. You're a higher risk and likely not going to get a loan at the bank. Most lenders prefer a 1.25 or higher to approve new financing. And the 1.25 is giving you essentially 25 cents on the dollar, right? That you're retaining in your business. Simple example. Your business earns $200,000 in operating income and your annual debt payments total $100,000. If you take the 200,000 divided by the 100,000, of course, you get 2-to-1. This means you're generating twice the income you need to cover your debt. This is a very healthy position. We'd like to see that. Then we talk a little bit about EBITDA.
Yep.
I can
Please do.
touch on that a little bit. So another factor that we look at is EBITDA. Does anybody know what EBITDA is? It's earnings before interest, taxes, depreciation, and amortization. Those things are non-taxable kind of events, right? So we're kind of giving that back to you when we're looking at your financial health. EBITDA stands for, and I just mentioned that, but in plain English, it shows how much cash your core business generates from operations. Before financing decisions, which could be loans, tax strategies or accounting adjustments affect the numbers. This makes EBITDA a helpful proxy for cash flow because it adds back non-cash expenses like depreciation and amortization. It strips out the noise. Interest and taxes depend on financing and location, not how well your business actually performs. It removes non-cash expenses, depreciation and amortization, reduce accounting profit, but don't reduce the cash in the bank. It shows true operating performance. EBITDA focuses on the money your business produces. The formula is super simple. EBITDA is your net income, interest, taxes, depreciation, and amortization. EBITDA is not actual cash flow, but it's often used as a rough estimate because depreciation and amortization are non-cash. It focuses on operations, it ignores financing and tax differences, and it makes a useful tool for comparing businesses or evaluating performance. You wanna add to that, Mary?
I'd like to add just on the 1.25 or higher, you might wonder why 1.25, why not 1.15, why not 1.5? The 1.25, if you think about it from the bank's perspective, if it's over that, it's a green light, you're good to go. If it's below that, a yellow light starts going off, and if it's 1-to-1 or less, that's when the red light goes on. So that's for the bank's perspective. For you as a business owner, you want that 0.25 or higher because you want to reduce your borrowing. You want to reduce the reliance on your line of credit. You want to have capital for a new piece of equipment or some new expansion. So the higher that number goes for you as a business owner, the better, because now you get to use your own money. You don't have to borrow and pay the interest cost to us. So we encourage higher numbers. These are just the minimums to give us that early warning indicator that we may have maybe trouble brewing. But higher, it's all for your benefit. Now, I say that, but I say higher retained. You know, if it's distributed out, it still doesn't help you, so retaining that extra 0.25 or greater helps your business grow, helps you have less reliance on credit, and improves your margins. That helps you get financed a lot easier, so.
Thank you, Mark.
Yeah.
Brian?
Why do businesses get denied? Or maybe, why do businesses get limited credit? And I've seen it, a lot of times you think you go to a bank and it's either a thumbs up or thumbs down. Sometimes the answer is this, like bank will say, I can't give you that $250,000 line of credit, but I can do 75,000. And so that can be disappointing too. So the answer is not always no. Sometimes it's okay a little bit. And that sometimes, yes, you have to live with that. But what can we do to help not get denied? Well, we talked about financial statements, messy financials. I call them messy financials because that kind of describes it. It's like, it's a mess. I guess talked about slow closing your books, not having your balance sheet reconciled, your income statement, your numbers going all over the place. I have a great examples. Another example, this company I was working with, their cost of goods percentage was running at about 60% for like 3 years. All of a sudden, one quarter it goes up to 65%. The bank asked why. The owner says, I don't know. And the banker kind of cocked their head. It's like, you don't know? And that's just indicative of messy financials. The banker didn't, or the owner didn't know their numbers, didn't know their financials. They didn't have a CFO telling them, your cost of goods is going up, and here's why. We need to fix that. So messy financials. And we talk about finances. What are your financials? Of course, your P&L, your income statement. That's absolutely, you gotta have that. Your balance sheet, which I sometimes call the forgotten financial statement, because business owners like to look at revenue and profits, all this stuff. I gotta reduce my expenses, reduce my profit, whatever. Well, over here is the balance sheet, which bankers love to look at. That's where your cash is at, that's where your receivables, that's where your loans are at. That is a critical financial statement. Sometimes bankers like to look at statements of cash flow. Oftentimes they want to look at your accounts receivable aging. We'll talk about that again in a minute. And your accounts payable aging. These are financials. I know we got some people in the construction industry here, and so your WIP report, your work in process report, is a critical financial statement if you're in construction or any kind of project-based business. Bankers want to see that because that gives them a view of what revenue is coming down the line and what kind of project costs are going to be coming down the line as well. So financials are critical. If those are messy or outdated, if you can't give them your 2024 tax return or your 2024 financials, bank's trust level goes down. If you can give them 2025 numbers now with your tax return, you're golden. I know sometimes that's out of your control, but do the best you can to give them as current financials as possible. Another area is, this is where your CFO comes in, your forward-looking financials, your forecasts. You want to give the bank a picture of what you're going to be doing in the future. And not only profitability, but cash flow wise. Some business owners I've talked to, their view of cash flow management is knowing if they have cash to pay payroll this Friday. That's not it. That is reactive business management. We want to get into proactive business management, which means a minimum of 90-day cash flow forecast. I say 12 months. Look at your 12-month forecast. Project where your highs and lows are on your cash. What's labor going to do over time? Is the seasonality in your business? You need to have all of this identified and in your viewpoint, so you can tell your banker, here's what we're doing. Here's where our revenue is going to be this month is going to be our expenses are gonna be at this level. We're gonna need $250,000 to get us through the typical winter low season. Or my business is super high pre-Christmas, but I need to buy all my inventory in the summertime. So I need cash in the summertime. Every business has reasons why they need to borrow. You need to draw that picture, create the story, show the banker your story and your forecast and forward-looking of what you plan to do in your business. That is a key piece so that they can trust your numbers. We talked about over-leveraged balance sheet. That is very, very typical. You don't meet the debt service covenant ratio, you just have way too much debt. We don't need to talk about that much more. I'll talk about tax strategies that could hurt your lending readiness. My CPA friends in the room, don't get worried about any of this. Well, you're okay. We'll talk about that a little bit more in a minute. And then the last one, I'm gonna step on toes here. I want to. It's toys, excessive distributions. You all go into business to make money, which is great. We want you to make money. You wanna do those nice things for your family. You wanna build a great future for your family. You wanna go on those trips. You wanna buy that boat, that RV. Those are wonderful things. Not things I wanna tell you don't do. I don't wanna say, forget that. What I wanna say is, if you're gonna take distributions for personal use, do it strategically and thoughtfully. Plan those out. Take the whim and the emotion and the urgency out of it. The better you are able to work with your banker, your tax advisor, your CFO to plan those distributions, even if they're for toys, even if they're for great things for your family, plan it so you aren't hurting your financial statements. If you take a bunch of cash out of your business for personal distribution, for toys or for good things, it can damage your ability to borrow money. I worked with a business owner a few years back. He was making, his revenue was 50 million, profit was upwards of 10 million a year. Great business, very profitable. But he was using his business as a personal ATM machine. He was taking hundreds of thousands of dollars out of his business monthly. And I said, time out. I'm your CFO, I have to at least have a discussion about this. Without getting too personal, what do you need this cash for? I wanted to make sure you didn't have a bad habit or something that we were trying to cover up. No, it was simple. He was going through a $2 million remodel on his home. Said, okay, great. Now that we know what we've identified the challenge or the problem, we can find a solution. So, no problem. You need you need 2 million. I was able to push back and stop him from taking the full 2 million out of his company. We dialed it back to 1.25 million. But we were able to plan those distributions so we didn't harm business cash flow. We didn't harm his working capital. We didn't damage his balance sheet. We did it strategically and thoughtfully. And these are the kind of conversations I want you to have before you want to take money out of your business. So please don't hear me say, leave all the money in your business, never take anything out, never enjoy life. No, enjoy life, but please do it prudently and thoughtfully.
One boat, not two.
That's what I heard. Or can we just call you every time?
Every time, 32-footer, not a 40-footer.
Okay.
Perfect, okay.
Real quick, one of the other things that I've experienced recently is that a lot of business owners don't realize how those distributions affect that cash flow when we're looking at it. So we talked about EBITDA earlier, but once you've taken those distributions, we have to deduct that as well, because you just took that cash out. So that's now your cash flow is even less than what you think it is. Because you've looked at the EBITDA and you're like, no, I'm great. Well, when it comes to lending, you're taking that money out, we have to consider that as well. So just something for you to think about when you're considering Brian's words when he's talking about prudent distributions.
I've seen business owners take money out of their company to buy toys, which we do. I mean, it's great. We all like our RV and boats and things like that. But then they've had a little bit of tough times, and they've had to sell that boat to put back into the business. Well, that $100,000 you took out of your business to buy that boat is now only worth $50,000 to put back into your business. So money going out of your company oftentimes depreciates overnight. So keep that in mind as well, what you're spending your money on, and that if you need that money back, it's not gonna be as much there as you took out.
Brian, can I interject just a couple
Absolutely.
things as I'm listening to all of you? The relationships are critical. If you don't have a relationship with your CPA, your banker, you need to develop one to have that conversation early and often. I say this is critical. Something came to mind, brief story I'll share. Customer came to refinance some of their loans, and family-owned business. They had a CFO that had been there for 10 years, trusted CFO. Everything was going great until they came in to talk with us, and all of a sudden, she had realized, she said, "I'm so sorry, I'm here to keep our appointment, but this is what I just found." She had not kept up on conversations the year prior with the CFO as far as accounts receivable. The accounting department had sent out invoices. The problem is they never followed up on them. So they not only were 90 days behind, she was massively behind in collecting those receivables. Like, we're talking a year out. And it was shocking to her, and you could just see her body language crumble. Now, had she come to us earlier, maybe she would have discovered it or not. So I say the relationships with your CPA, your banker, but most importantly, internally, if you do have a staff, even if it's a staff of one, have consistent conversations. Put that in a plan. How are you collecting on those? Have you followed up on them?
Put that statement in your brain. I'm gonna come back to that in about 5 minutes. It's a very key piece. Talk about tax strategies. All right, Ben, Zach, Maria, don't worry. Oh, we can't talk about. Well, let's talk about tax strategy. There we go. Oh, there we go. Okay. What I say here is that minimizing your taxable income can also minimize your lendable income. And so this is where you have to make sure your tax CPA and your banker and your CFO and you as a business owner are all on the same page and all communicating and talking. If you as a business owner have a plan to borrow money in the next 6 to 12 months, you need to have that conversation with your tax CPA. You need to have that conversation with your CFO. Because if you may be pursuing a tax strategy that is minimizing your taxable income, reducing how much you have to pay in tax, and it could be hampering your ability to borrow money considerably. And so if the sooner those conversations are had, the better off you're gonna be as far as borrowing money. And I'm not saying I'm not saying go pay unnecessary taxes. No. I'm saying, here again, we're talking about prudence and conversation and communication and building that team, yes.
Can you put them all in the same room at the same time?
They won't kill each other, I promise you. Yeah, but yes, that would be wonderful if you could. Or teams, let's do a Teams call. It's so easy nowadays. Those great conversations, because you get all in one place. Everybody knows what each other is trying to accomplish. Everybody's goals can be a little bit different, but as long as you are all in agreement on what the end result needs to be, everybody's professionals, they can all make it happen and help the business owner achieve what they want to achieve. Yeah, it's aligning those goals, making sure that your tax goals and your personal borrowing goals are in agreement. There, did I say anything wrong, tax folks? Okay, I wasn't gonna give any tax advice. Okay, now from a CFO perspective, what's it gonna take to become bank ready? We talked about some of these looking at monthly financials, know your numbers. Know your numbers inside and out. If you don't know them, talk to your CFO. Your CFO will help you know what your numbers are saying. Build that long-term view, the forecasting, key, it's critical. Be able to give the bank an idea of where your business is going. Be proactive about your borrowing decisions. You've heard this in other contexts, you know, the best time to start planning for something is 6 months ago. The second best time is today. The same goes with borrowing. The best time to plan to borrow and get ready for borrowing was 6 to 12 months ago. The second best time is start now. Never too late to start, never too early to start. So if you're thinking borrowings in your future, start working on it right now. What's it gonna take? And a lot of times having a conversation with your banker, they'll be honest with you and tell you how prepared you are. Other thing is KPI and key management reports, gotta have those. Look at those daily, weekly, monthly. Know where your business is going. If a banker knows you're looking at key numbers, it's gonna be wonderful. Now, overarching all of this, I want to introduce a concept that I think as business owners, you probably all know, which is concept of working capital. But what is working capital? Simply, it is the money, the cash you have to run your business. And usually it is derived from an equation. Don't want to get all mathematical on you, but it's your cash and your short-term assets that you can convert to cash. Usually inventory and accounts receivable. And you just take away your accounts payable, what you have to spend money on. That's considered your working capital. Now, a lot of times businesses are showing a great profit, and profitability is not a problem for them. Their problem is working capital, because they have a lot of cash tied up in their balance sheet in working capital. Cash is great. Like Victoria said, sometimes you got accounts receivable. You can have bloated accounts receivable aging with hundreds of thousands of dollars of money owed to you. That's not being collected. You have inventory. You could have 4, 6 months worth of inventory. That's just money sitting on the shelf. And then maybe your vendor payment terms are not favorable, so you're paying for your inventory before you're even selling it. That's gonna cause a real cash crunch. Let me tell you about one example that really exemplifies the challenge with working capital. It was a wholesale distribution company. They had like a 90-day lead time on the product they were bringing in. They were having to pay for it up front. So they would pay for product up front, take 90 days to arrive, so they're out the cash. That's cash flow problem number one. Number two, they would sell the product, but they had receivables that were like $1 million. The revenue was $13 million. They had $1 million of revenue of accounts receivable on their books. Like a whole month's worth of sales needing to be collected. A big chunk of that was 60, 90, 120 days. Let me be just the bearer of bad news. The National Association of Credit Managers, this is like a 5-year number ago, but they said at that point, if any receivables that got to 90 days, there was a 75% chance you would not see a penny of that. Think of that. Let that sink in. If you allow a receivable to get to 90 days, you're gonna have to start considering writing off 75% of that. That is huge. Of course, that's national average. Your business could be different. I wouldn't take it for granted. The same distribution company had $1 million. A big chunk of it was in 3 customers. One of them was over 90 days. One was over 60 days. The third one, they could not get a hold of. So that is a huge amount of cash sitting there, working capital, they couldn't touch. They couldn't pay their employees, they couldn't pay their vendors, they couldn't pay their bank. Now, the last place was inventory. So their revenue was $13 million a year. Their inventory was $4 million. Think of that, a third, 33% of annual sales was tied up in inventory. That's cash sitting on the shelf. To make it worse, a big chunk of it was obsolete, not worth even 10 cents on the dollar. That's cash that is just out the window. At best, it's sitting there, excessive cash is sitting on the shelves collecting dust that you can't use. So I talk about working capital because if you don't have an eye on your working capital, that plays into your ability to pay your debts. And bankers are gonna look at your working capital. When they pick up a balance sheet, they're gonna look at your debt, look at your equity, look at your working capital. And if your working capital is upside down or a challenge, it's gonna reduce your ability to borrow money. There, that's the somber boom, boom. It just happened, you heard it. So the next thing, I want to turn it over from a banker's perspective. What can you do this week? Come on, bankers, tell us what they can do right now. What can they do?
Help us out.
Well, they can come to this seminar and raise it.
Hey.
Right? So, we're risk managers, right? We're trying to mitigate risk, but we're also looking out for you guys. So creating, as Victoria said, creating those relationships early, are key. We can guide you, we can see maybe something that you're not seeing. We can even provide you questions to take back to your CFO or your CPA and find out how healthy your company is. Being bank ready means you've aligned your business with how lenders think, not just with how you operate day to day. Loan readiness requires, as Brian has already mentioned, clean credit, organized financial documents, clarity on the purpose, and demonstrated repayment ability. Because again, as Brian mentioned, we want to lend the money, but we also want you to give it back. So clean and organize your financials. Banks expect accurate, consistent, lender-friendly financial statements. These include profit and loss statements, balance sheets, bank statements, business and personal tax returns. As was mentioned earlier, we also on occasion look at your accounts receivable, your cash statements. So incomplete or inconsistent records delay approvals and or trigger rejections. Cleaning up your books early, reconciling accounts, fixing errors, and removing inconsistencies. These are all the many ways that Anthem Strategists can support you and your business as well. Assess your financial health honestly. Before applying, review those financial statements, those revenue trends, your profitability, cash flow stability, DSCR. Oh, there's a trigger word. Didn't we talk about that? Identifying red flags early gives you time to fix them before we see them. And again, build that relationship with your banker early. Relationship banking matters. When a banker understands your business, they can guide you, advocate for you, and help you prepare a strong application. This is the core part of bank readiness.
I'll add a comment. I found bankers to be multiple varieties. The great bankers that I've found, like I mentioned before, know your business really well. They know you, they know your business, and they are able to advocate for you. Not that they're going to tell a story or tell lies, but they're able to go to their bank underwriters and present all the facts and share the story and help the underwriter see the story, and understand what's going on in your business, so they can get to approval. They want to help you and the underwriter get to yes. And so good bankers can do that. And so I say that because we have great bankers right here. And hopefully you guys are working with great bankers, and they're wonderful. If you're not, if you don't have a good banking relationship, I can highly recommend Drew, Victoria, and Mark, and anybody at People's Bank. Great people, wonderful to work with, great knowledgeable experience. I love the young, hungry bankers, but there's something to say about gray hair, you know?
Absolutely.
He looked at me when he said.
I've been told that's what experience is.
Experience does, it does. And, you know, I steal,
Oh, wisdom strand.
wisdom, I
Okay.
steal it from the insurance company, you know, we know a thing or two because we've seen a thing or two. So we're able to share some advice because we've been around the block a couple of times. And so utilize that advisory strength and that wisdom that comes with experience. And so I highly can recommend the folks at People's Bank. So we're gonna go on, before we go into questions, wanna offer a couple things. I am offering anybody online or here, I put together a little prize. It's 5 pitfalls of cash flow management that many small businesses fall into. And so financial forecasting, how to identify risks, and I'm offering that. Just come spend 30 minutes with me, email me, call me, let's schedule that, and we can do it via Teams or in person. I'll even buy you a coffee. And we can look at your business and talk about what's your cash flow forecasting look like, and I offer that free for you guys, complimentary for being part of the seminar today. And Victoria?
Absolutely. So that's one thing that we love doing. If you have a good relationship manager, they love sitting down and talking with you. They're gonna ask questions, they're gonna be curious and ask why. They're gonna ask why again, until they can really get to the meat of what you're doing and where your mind is going and what your plans are. Sometimes you forget that it's important for us to know some of the small details. The other thing we like to do, if for your specific industry, we like to understand the industry. So we're gonna do some research ahead of time. Try to stay ahead of the winds, if you will, so that if we see some, whether it's tariffs or whatever it might be, some headwinds coming, we may pick up the phone call. Your RM should be doing the same, whoever that is. Hey, you know, I just was reading this in the paper. How are you planning for this coming forward? Oh gosh, I hadn't even seen that. Thank you. So it's that awareness, that really is that relationship to take care of each other. The risk management, we want you to be successful. In turn, we're successful if we can have you win and continue to grow, whatever that looks like. So, Mark?
Yeah, so I think, and thank you for that. Demystifying this process so that you have access to capital is what we wanna do. And it's not, you know, if you're humble enough to say, here's where we're at, we'd love to have that conversation and to build the trust to help you get to where you wanna be. And I've had that conversation, we just met with a prospect a few weeks ago, and they hadn't borrowed commercially for a long time. And we were able to, just in a prospect meeting, solve 2 things for them that they had no idea regarding the financing that they needed. And they walked away saying, man, I really appreciated what you guys brought to the table. And that's what we're here to do. We're here to help get access to capital so that it's not so threatening.
You may come in asking, you know, I need $500,000 line of credit. Great, let's talk about why. And you may walk out without that $500,000 line of credit because it really wasn't the best solution for the end result. But we also help you understand the whys behind that. It's fun.
That's one thing I think that we've talked a lot about, you know, cash flow and how to have clean financials and how to build those relationships. But we're not just bankers. What I've been doing for the past 6 to 8 weeks, I guess, is getting to know the businesses in my community. I wanna come to your establishment and hear about what you're doing. Maybe you need financing, maybe you don't, I don't care at this point. I just wanna learn what everybody's doing, what everybody's involved in. What are your ideas? There are so many entrepreneurs out here right now coming up with some great ideas. Mark and Victoria just visited one most recently. And we care about that. We don't wanna just look at the numbers and create loans. We wanna know what y'all are doing and what you're interested in and what you're building in your lives.
The other thing Anne Marie and I were talking about before we started, we love connecting. As Mark and I met with this prospect, my mind was just swimming with, oh my gosh, you need to meet these 5 people because that's gonna help you grow. And so I may not offer that right at that moment, but I've got it registered to circle back because it's that important, whether or not we end up doing a loan or banking, we want you to thrive. Hopefully you'll bank with us at some point, even if it's a portion, but it's really about that relationship and community.
Thank you. Now, open up for questions. Anybody have questions? Yes.
Hey, Brian.
Yep.
This is kind of a technical question, but when you're building out a forecast, what driver ratios do you scrutinize the most?
It really is going to vary by the business. Different businesses have different drivers, you know. No two businesses have the same KPIs. And so it's gonna be unique for that business. You know, simple ones that I always look at, no matter what the business is gonna be. If it's cost of goods, labor percentages, profitability, of course. And then on the balance sheet, we're gonna look at, current ratio, it's a working capital ratio, current assets over liabilities, your debt to equity. We talked some of these basic ones. Those are real simple ones. I'm gonna look at every business, and then beyond that, it's gonna be very unique, driven specifically for the business and its unique circumstances.
Okay, thank you.
Yep. Yeah.
What do you suggest for businesses there are different types of business owners, right? And there are business owners that are just not number savvy. They're very good at what they do. They want to own their own business. They own their own business and they have no interest in the numbers as long as they're making money. So that person, when they say, hey, I think I'm gonna need a line of credit, I would think that it's really important to outline them with steps. You need to talk to this person and then and help that team come together to present their need once they're ready, or
Bankers, if a client came to you like
Yeah,
that, what would
That's a
you
great question. That person would then need to abdicate that to a trusted partner. A CFO, for example, or someone that they trust to understand the numbers, to be able to communicate that, to access that capital. We're not the only source of capital, but we can be a convenient source for a lot of businesses, but not knowing the numbers can make it challenging. So having a partner in your business, whether it's someone you've hired or a key partner, to me, that would make the sense. And if that's not the case, then build a good relationship with the banker. Let them come in and do the tour and see what's going on. Have a better understanding, because a lot of times they can translate what the person that doesn't know the numbers we can translate that and still get comfortable making the loan.
the industry that comes to mind is contractors.
okay,
A lot of them are just not, they don't like the paperwork, they've got somebody else that does that, they don't, in regard to the numbers, and so it can be very challenging for them to.
And to try and convince that mindset, and I know what you're describing, there's many out there like that. And just that continual conversation, I know someone, and I always think of Brian because you have a specialty niche, so to speak, that you can really help businesses, whether they hire you or whatever, just for that consultative, let me take you, if it's a business that you really love working with, or a friend or someone, hey, let me introduce you to Brian, we're gonna have coffee, half hour, let him just explain what he can help you with after he understands what you're needing. And they can come in and say, I hate numbers, I'm the visionary. There are hundreds of people out there like that. The numbers and they don't care about them, but they need to. And so how do you partner, how do you convince them to partner with a trusted advisor, trust and verify, so that they can then thrive and be that visionary that they want to be? And it really is trying to get over that hurdle of an ego, of discipline. I just don't want to do that. I get that, but if you really I want you to thrive. And I'm not just selling Brian, but Brian's the first one I've ever met that does what he does, and he does it well. I've watched him over the last 3 years, I think it's been now. So just an idea.
and I'll just piggyback on that, it's like entrepreneurs are visionaries so often. They have a great idea, they have a passion for a product, a service, what they do. And the details are not what they're focused on. They're focused on producing a better product, doing, growing sales, all these things. And so, yeah, I just, they need a partner, a strategic advisor, someone to come alongside them to help interpret the numbers, help them understand what's going on in their business, and to sometimes help them tell the story. So, yeah, and so.
Think of it, in CPAs also, think of this as a consultative approach to really help them understand the whys. I've seen multiple businesses over the years that have crossed my path and been in conversations for lending or otherwise, where their internal staff, maybe they have a small internal finance team, so to speak, and they just let them do their thing. Or they decide one leaves and they think, well, we're just gonna hire Susie across the street for a lot less money, for half of what we were paying them. But they don't really understand the background of the details that they really know how to do, whether it's Excel spreadsheets or just managing dollars or the systems. Those sound like really ancillary things, but they're really critical. You as a business owner find someone that can help. And so that's where you can come along, as that consultative approach, CPA, banker, or otherwise. And it can propel them to success as they're stumbling through the storm that was created because they were trying to save money, and maybe they hire 3 people for the one that just left. Did you hire the right 3 people? And we all know how difficult it is to find good people that fit the role that we have in front. You've gotta be patient and really connect and ask and say, hey, I've got this position open. Do you know anyone? It pays to know people, it pays to talk and pull those people into your circle of influence.
I know we didn't ask you to ask that question, it wasn't a plan, but it's a great question because it really hits the core here. And not to shamelessly plug CFOs, but a lot of times small businesses have a great internal accounting team, a bookkeeping team. They do great at making sure the historical information gets recorded correctly. But who does the business owner have to help them see into the future? To see what's coming down the road, understand what cash and profitability is gonna look like in the future. That's what a lot of times business owners don't have. They don't wanna take the time to worry about that. They just wanna do what they have a passion for. And so that's why we wanna help them find someone to come alongside them. Because if we find that right person to help that business owner, their business is going to blossom because of it.
The other scenario I've seen since 2020, since COVID, multiple businesses of all sizes started out small, rapidly grew within a 3-year period. Their internal staff, they themselves as owners, their internal staff, they weren't keeping up with what was happening. And all of a sudden they have this growth from maybe 3 million annual revenue to 20 million in a 3-year period of time. It's like, wow, this is fantastic. What just happened? The internal staff can't keep up with that. And so they scramble to try and find, that's where Brian can come in and help that consultative, let me kind of help you streamline and go forward. Because now they're in a situation that it's great and they want to continue growing, but they didn't put the infrastructure and the foundation internally in place.
Thank you for the question. Excellent
Yeah,
question.
thank you, Tracy.
Other questions?
Maddie, I see your wheels turning.
I didn't really follow along the lines of lending though, from a bank's perspective, but I'm thinking of a business that is maybe has really healthy cash flow and revenue. What's something you would suggest for them to look at maybe on an investment perspective, or maybe it's time for them to take out a loan even if they don't need it to grow? More of a comment, I guess, but.
Could be more projected. Because they're wanting where to invest their extra capital.
We probably would have introduced them to a wealth advisor for sure. That'd be part of the discussion. But also, it would be talking to them about their plans for the next couple of years. Like maybe this is a time to start thinking about, I've always wanted to move out of this office and buy a building. Well, let's start talking about those type of strategic decisions or conversations. It's always a good time. And, strategy going forward of business, and it all plays back into the money, the numbers, the forecast, your business, where it's going. And then we bring in the other people, whether it's wealth advisor, banks, lender, whatever. We bring the people into the discussion that need to be there, because the more people you have with wisdom, it's gonna help you make better decisions, yeah.
Yeah, and I would say, Maddie, too, as you're looking at that, wealth advisor, CPA, banker, interview them. Interview them, find out if they're the right fit, if they're the right personality fit, if they're the right mindset. If you're looking for somebody that's going to come at you and say, this is what I see that you need to do, and that's what you need, tell them that. It just opens the door for really deep conversations. The other thing that you just made me think of is succession planning. Many businesses do not have a succession plan in place. And what's really has been eye-opening to me are people in their 60s, 70s that still have their own business. They have no succession plan. Their kids don't have any interest in the business, they never thought about it, and all of a sudden, age hits. It's like, oh, I didn't plan for this. We've talked about it for 50 years, but you get busy doing life. And so that's another strategy. Sometimes that wealth manager just, I think would reach out but again, find that right person that's a good fit.
I wanna just real quickly, I think, running an HVAC company successfully to a point where it's mature, it doesn't need financing, and then trading that excess cash flow for other investments that aren't related to HVAC can be a challenge. Like, how many people that run an HVAC company understand the pitfalls and opportunities in a multi-tenant office complex? But hey, I've got a bucket of money, that looks like a great opportunity. I'm sure George back there would say it's not as easy as just buying a building and letting it go. There's still risks and pitfalls for running an investment portfolio, and you have to know what you're getting into. And that again comes back to having good advice, good advisors, people that are in the industry that you can talk to. And so not every successful business owner can translate that to investment properties without some help along the way.
And going back to what Tracy was asking, people think they can handle all of it on their own. And in this world anymore, you can't. To be honest, you're bringing up some horror stories I'm thinking of. That one was a wife had worked for a large company that sold, and they hadn't talked to anyone as far as trust planning. And they ended up, because they didn't do it right up front, they waited a few months into receiving the funds. They ended up paying $300,000 to the federal government that they would not have needed to pay had they only had that conversation. So those are not to scare people, but it's just really being mindful of the importance of slowing down long enough to take care of yourself and where you're looking forward. It's real important.
Well, that also then goes back to the relationship aspect, because you have a relationship with your CFO, you have a relationship with your banker. We do the networking and can give the referrals to say, here, go talk to these people. And so then it just goes back to that relational aspect of, how can I trust my banker? How can I trust my CFO? Where do I need to go? So then that way we are also able to help you and go with that.
One last thing I want to share, because I think it is hitting all industries right now. Dentists, dental offices, CPA offices, cemeteries, many of those are being gobbled up by large corporations. There are those small business owners that don't have a succession plan, no children want the business, but they don't want to give their business up that they have. Maybe it's a generational business, they don't want to sell, but they don't know where to turn. So they keep working until they finally can't work anymore, and then what? And so I share that with you because, again, I had this conversation with somebody a couple weeks ago, and I said, so what are you going to do? Probably end up giving it away to this big national company. I said, and I'm trying to think of, at that moment, I couldn't think of any connections. They need to speak to someone. I said, have you talked to a financial planner? Have you talked to anyone? No, I need to do that. And it's, don't wait any longer. So, you know, if you can influence them at all, again, you're after their best interest to try and help.
Thank you for the great question, excellent questions. Any others? All right, well.
Wait, Maddie? Are you sure? Okay, I just see those wheels turning.
Well, it's been a pleasure to share, and I just trust you're gonna walk away with at least 1 or 2 nuggets that you can utilize. And if not, the great thing is, we're an email away. Please, I invite you to email us, call us, we're here, we're gonna be sticking around for a little while, come and talk. But besides that, thank you for coming today and giving us your time, and hopefully you got something out of it, so appreciate it, thank you.
And one more, like I dropped off some little reviews on your tables, if you could please fill those out before you leave and leave those here with Kelsey, that'd be great. Thank you.
Thank you, guys.
Thank you.